What's going on, everybody? Chris here from projectoption.com, and in this video we're going to talk about the iron condor adjustment of rolling down the short call spreads. So here's what you're going to learn from this video. First and foremost, we're going to talk about what rolling down the short call spread means and when you typically would make that adjustment. Now second, we're going to talk about how rolling down the call spread can minimize risk and maximize the profit potential in a troubled iron condor position. And lastly, we're going to discuss the one drawback of rolling down the short call spread. Now before we get to the fun stuff, let's first discuss what rolling is in options trading. So sometimes you'll need to make an adjustment to one of your option positions, and in this video we're going to be talking about the short iron condor position. Now rolling is the process of closing one of your existing options and opening another option at a different strike price or in a different expiration cycle. Now today we're going to focus on rolling down the short call spread of an iron condor position when the stock price decreases. Now when a trader sells an iron condor, they're making a bet that the stock price is going to trade sideways over some number of days into the future. Now unfortunately in this case, let's say the stock price drops like a rock right after they sell that iron condor. What is this trader going to do to go into defense mode to protect their hard-earned capital and minimize their loss potential? Now the go-to iron condor adjustment strategy is to roll down the short call spread, and that is done by buying back your old short call spread and then selling a new call spread at lower strike prices. Now what exactly does this iron condor adjustment accomplish? Now by closing the old short call spreads and selling new call spreads at lower strike prices, short iron condor traders accomplish two important things. The first is that they collect additional option premium from the rolling adjustment, which reduces the maximum loss potential of the trade. Now that is assuming that the spread width remains the same. Now don't worry if this doesn't make sense just yet. We're going to go through an in-depth example in just a minute. Now the second thing rolling down the short call spread accomplishes is that it neutralizes the position delta, since rolling down the short call spread actually adds more negative deltas to the currently positive delta position. So let's go through some in-depth examples. Now let's first discuss how rolling down the short call spread collects more option premium. Now consider a trader who is short the 160-165 call spread in their short iron condor position, but rolls down to the 150-155 call spread. Now to make this adjustment, they're going to have to buy back the 160-165 call spread and then sell the 150-155 call spread. Now since they sell the 150 call for $3.84 and buy the 155 call for $2.02, they collect $1.82 from selling the 150-155 call spread. However, they're also going to have to pay to buy back that 160-165 call spread. So since they're going to have to pay 94 cents to close the 160 call, and they're going to collect 41 cents from selling out that 165 call, they will pay out 53 cents for closing the 160-165 call spread. Now since the trader collects $1.82 from selling that 150-155 call spread and pays out 53 cents to buy back that 160-165 call spread, they collect $1.29 of additional option premium. Now that means this iron condor position will have $129 less risk and $129 more profit potential than it did before they rolled down that short call spread. Now let's talk about how the position's directional or delta exposure changes from rolling down that short call spread. Now at the time of rolling down the short call spread, let's say the trader's position delta is positive 20. Now that means they're expected to lose $20 if the stock price decreases by $1, and they're expected to make $20 if the stock price increases by $1. So as we can see, they have a bullish directional bias. Now since that 160 call has a delta of positive 17 and that 165 call has a delta of positive 9, their short 160-165 call spread currently has a delta of negative 8. Now that means that their short call spread is expected to bring in $8 in profits if the stock price decreases by $1, and they're expected to lose $8 if the stock price increases by $1. Now since that 150 call has a delta of positive 47 and the 155 call has a delta of positive 30, the short 150-155 call spread that they rolled down to will have a delta of negative 17. Now that means that the 150-155 short call spread is expected to bring in $17 in profits if the stock price decreases by $1, and they're expected to lose $17 if the stock price increases by $1. Now, since the new call spread we just sold has a delta of negative 17, and the old short call spread that we just bought back has a delta of negative 8, we reduce our position delta by 9. So that is the difference between the new short call spread delta and the old short call spread's delta. So since the initial position delta was positive 20 at the time of rolling, and we reduce our position delta by 9 by rolling down that short call spread, our new iron condor delta exposure is positive 11. So that means if the stock price decreases by $1, we're only expected to lose $11 as opposed to $20 before the roll. Now at the same time, that means we're only expected to make $11 if the stock price increases by $1, when before the roll we were expected to make $20. Now, as we just discovered, rolling down the short call spread has its benefits, which are increasing the profit potential and decreasing the loss potential, but there are some downsides. The first downside is that the probability of making the maximum profit decreases as the range of maximum profitability is now narrower than it was before you made that roll. Now, the second downside is actually one of the benefits, and that's that your position delta gets neutralized. Now, since you brought your position delta from positive territory closer to zero, that means a subsequent rally in the stock price will yield less profits or no profits than if you did not roll down that short call spread at all. So before I let you go, I want to hop over to the trading platform and show you a more visual and realistic demonstration of rolling down the short call spread to further your understanding of this topic. Okay, now that we've talked about the basics of rolling down the short call spread in an iron condor position, let's step out of the classroom and into a more realistic trading environment and look at a hypothetical iron condor position that has recently been, getting closer and closer to being tested on the put spread side. Now that means the stock price is getting close to the short put spread, and maybe we want to take action and roll down that short call spread. So let's say on May 2nd, 2017, you thought Facebook was going to lose some steam after this incredible stock price increase, and you thought Facebook was going to trade sideways for the next 30 to 60 days. So let's say on May 2nd, you went ahead and sold an iron condor position in the June expiration cycle that would expire somewhere over here in June, so mid-June. So let's go ahead and see what those iron condors are trading for on May 2nd. So as we can see here, we're in Facebook in the June expiration cycle on May 2nd. And let's say with the stock price at $153, you sold the 145-140 put spread, and then you sold the 160-165 call spread to complete your iron condor position. Now let's say you collected $2 in this case, just to make the math a little bit easier. And let's go ahead and see what would have happened if you would have held this position until today. So with Facebook today right around $148, that stock price is now closer to your short put spread. So if we if we go ahead and add this position to the risk profile, we'll be able to analyze what it is worth right now. So right now we can see the position is worth 94 cents, but let's reset that price to $2 since that was our entry price. Now with an entry price of $2, we can see that anywhere between $145 and $160, our maximum profit potential is $200, which is that blue number in the lower left-hand corner of the risk profile. So that $200 comes from that $2 credit we received times 100, which is the standard contract multiplier, which comes out to a max profit of $200 per iron condor. Now, since each of the spreads in this iron condor are $5 wide, we have $3 or $300 of loss potential on both sides. So if our short 145-140 put spread is entirely in the money, or our short 160-165 call spread is entirely in the money, we will lose $300 at expiration because this iron condor will settle to a value of $5, and since we sold it for $2, we'll have a loss of $3 per spread. So remember that when we sold this iron condor, Facebook was right around $153, which would be right at this mark right here. Now the stock price has fallen to $148, and we can see that that's much closer to our short put spread. And if we look right here, we can see that our delta position is positive. So since the stock price has fallen towards our short put spread, our position has taken on positive deltas, which means we're going to start losing more and more money as the stock price decreases. So one thing we can do is we can roll down that short 160, 165 call spread to a lower call spread to collect additional credit and neutralize our position delta. So let's go ahead and see what that would look like with today's prices. So if we go to the June expiration cycle and we buy back that 160, 165 call spread, and let's say we're going to sell the 150, 155 call spread, which is pretty much rolling to the at the money strikes. So we're going to sell that 150 call and then buy the 155 call. And we can see that we do this for an entire credit of $1.25 just to make it easy. So when we go ahead and analyze this position altogether, let's go back to what we had before. So right before we had a maximum profit potential of $200 and a maximum loss potential of $300, and our maximum profit potential was anywhere between $145 and $160. Now if we buy back that 160, 165 short call spread and roll it down to the 150, 155 short call spread for a net credit of $1.25, we'll see that our maximum loss potential will decrease by $1.25. So now we can see that if our short 145, 140 put spread is entirely in the money, we're only going to lose $175 now because our net credit is $2 plus $1.25 or $3.25. Now since our short call spread and short put spread are $5 wide, that means we can lose a maximum of $1.75 per spread, which is, clear when we look at the maximum loss on each side. Now, in addition to that, we can see that our maximum profit potential has increased from $200 to $325, but the downside is that our maximum profitability range is only between $145 and $150. That's because we rolled down that short 160, 165 call spread to the short 150, 155 call spread. And since an iron condor's maximum profit potential is any price between the short call spread and short put spread, that means our maximum profit potential in this case is with Facebook in between $145 and $150 at expiration. Now, in addition to that, we can see that our position delta has actually gone into negative territory. So it's now -7 as opposed to +15. So maybe in this case, we wouldn't have rolled down to the 150, 155 call spread. But this is just an example that shows when you roll down your short call spread after the stock price has decreased, you will collect a net credit, which will increase your maximum profit potential, decrease your maximum loss potential, and it will also bring your position delta closer to zero. And in this case, since we rolled pretty aggressively, it actually got slightly negative. But the fact of the matter is, before this roll, we were expected to lose $15 for each $1 decrease in the stock price, and that's because our position delta was +15. Now, if the stock price decreases by $1, we're actually expected to make around $7. So this would be a bit of an aggressive roll, but nonetheless, this is how rolling down that short call spread can be used to defend an iron condor position after the stock price decreases. Now, to sum things up, when selling iron condors, if the share price falls quickly towards your short put spread, a common iron condor adjustment to make is to roll down the short call spreads. Now, by rolling down the old call spreads, you collect a net credit which increases the maximum profit potential and decreases the maximum loss potential. Now again, that assumes the call spread that you roll down to has the same width as the old short call spread. Now lastly, the downside of rolling down the call spreads is that you decrease the probability of making money, and that's just because you have a tighter range of maximum profitability. And additionally, you'll make less money or potentially lose money from subsequent increases in the stock price. And that's because you neutralize your directional exposure. And if the stock price rips higher after you roll down that call spread, you now have a higher likelihood of losing to the upside. Thanks so much for watching this video, everybody. If you enjoyed it, please give this video a like, leave a comment down below, share it with your friends, and please subscribe to our YouTube channel if you enjoyed it so you can get all of our future options trading content. And lastly, if you want to check out some more of our videos, go ahead and click on that video link on the right hand side.